Hello, welcome to ME 510, Economics and Policy of Engineered Energy Systems. This is part two of our four-part module series on the origins of fossil capital. Let's start the second part by talking about technology adoption. In general, there are four phases for the adoption of a new idea. Those are listed here. In phase one, most people will have never heard of the technology or concept. In phase two, once they hear it, they might right away say that it is wrong and discard it from the beginning. In phase three, they might start to admit that it is right, but they will not understand the significance of it and deem it irrelevant. Finally, in phase four, once the concept is adopted, the general population will say that they have been saying this all along. I want you to think about technologies, concepts, and ideas that you are familiar with, and see if you recall going through all these phases, either individually, through a group, or just through the national media, for example. I think that you will find that this happens quite often. Now, oftentimes, the technology adoption is the least remembered aspect of change. If history is a guide, it is likely that the technology side of things will be forgotten in the turmoil of political events that accompany it. To give you an example, make this more clear, think about all the wars and battles that we've had over oil. Um, Now, if you look at oil consumption worldwide, you can see that it's been declining, demand has been declining, and prices have been suppressed. Um, Now, the wars that have been fought over oil have been more significant in terms of their historical impact than the fact that the world is finally moving into more renewable types of energy. And so this is a theme that you're going to see in terms of energy systems, that they do allow significant changes in how we use energy, but they're often accompanied by some social political change that is what history tends to focus on. And the way technological adoption occurs often follows economic cycles. And so we're just going to look at a few slides here talking about the business cycle. What this chart is showing is that when you look at the stages of business cycles, you can break it down into 6 different stages. During this 6 different stages, you go through periods of recovery and recession. Um, and on the left side, what we're looking at is the investment, what consumers are investing on. In stage one, when we're moving into a recession, consumers who will be nervous about investing in high risk stocks, for example, will put their money into bonds, which usually a low, um, have an attractive rate during this period. At the bottom of a recession, suddenly stocks will have very low value. That's one of the things that people focus on when there's a recession. And so, because of the low value, it will attract new investors looking to buy bargains. Uh, Once stocks start appreciating in prices, suddenly commodities will start looking cheap relatively to stocks and bonds. And so, consumers will start investing in commodities like oil, gold, silver, and other types of commodities. Now, as people start investing in these financial assets, their prices go up, making bonds seem a relatively safe investment, particularly if you're concerned about a significant drop in their price. In stage five, you can see that stocks may suddenly be overvalued, and so consumers will start selling out their stocks, selling out commodities by stage six, and we're back to stage one, where bonds suddenly become a good investment. This economic cycle occurs periodically over different periods of time, depending on the country or region, but they are fairly prevalent and it's a well established notion. Here's an example from the United Kingdom. You can see here there are periods of recessions and recoveries and booms as well. And you can see this economic cycle shown here as a function of the growth of national output, the annual percentage change in gross domestic product. Okay. Now, you can see here towards the end, after 96, it appears that the UK is going through a period of stability. But even in what's marked as stability here, you can still appreciate some uh, economical cycle in terms of growth and decays. What about the US? Well, this is an excerpt from an article, and it talks about the significant rise of the Dow Jones Industrial, which is a financial index here in the US. You can also see the S&P 500, which follows pretty closely with the Dow Jones. And you can see that from 1990 to 2000, there was this rapid growth in both indices. Okay. Now, around 2000, we start to see the beginnings of a crash. At this point, people know that these stocks are overvalued, but they still continue to invest in these stocks because of the gains that have been attained in the previous decades. But if you invested too late, then you see that from 2000 to 2002 and 2003, there's a dramatic drop in the value of these indices. And certainly this drop, again, it's an average. If you were investing in some of the high rising stocks and didn't do really well here, my apologies. But as you can see, um, these cycles of economic growth and recession are found in many different countries and contexts. What about the world in general? Well, if you look at the output growth from 1961 to 2012, you can see that both developing countries and advanced countries have these cycles of growth and recession. 2009 was particularly bad for the world in terms of GDP growth. We know that there was a major recession at the time, and in terms of advanced countries, they even moved into negative growth territory. And the rebound from that has come mostly from emerging nations and emerging powerhouses. China, India have seen significant growth since that time. But you can certainly see that all countries around the world contribute to this economic cycle and that it's well established. Now, how do economic cycles relate to technological adoption? Well, a lot of new technologies are either adopted during these periods of growth or at least help enable the growth in the economic cycle. One thing that you have to keep in mind is that not all technologies are adopted at the same rate, and there's not really a good rationale for that. What that might be, it really does come down to social adoption, economic contexts and situations, political decisions. But what this chart tries to show you is a view of what were the expectations for different types of technologies and how fast were they adopted. So you can see, for example, human augmentation, the expectations are relatively low, and its adoption has been so far very slow, with more than 10 years expected before it's adopted. However, if you look at social software, Twitter, Facebook, the expectations there that they're going to uh, bring the world together, and they have been adopted in 2 to 5 years. And so you can see that certainly they've seen a high expectation. Some would say maybe inflated, because certainly they can change the world in some ways, but they're not going to cure hunger, maybe. Those are some of the things that this chart tries to indicate. You have technologies that had a trough of disillusionment, RFID, social network analysis. Some technologies just haven't made it as was expected. Okay, that concludes the second part of this module. We will now move on to part 3.